Hello and welcome to the Mortgage Credit Certificate Refresher Training. My name is Kirsten Partenheimer and I'm a Program Manager for the MCC program. We have some exciting updates about the program. Although we are winding it down, funds are still available. And so we encourage you to lock commitments for any borrowers for whom the MCC would be a good fit. And we ask that you do that by December 18th, and those loans must close by December 31st, 2017. In other news, we also have a new lower rate for the MCC program. So all loans locked with an MCC will have the same rate as the startup program. Since this is a refresher training, I'm going to assume that you all are very familiar with this startup program. And if you have locked loans with startup, then you will understand the eligibility requirements for the MCC program because they're all the same. So just like with startup, MCC borrowers have to be first-time homebuyers, meet the MCC income limits, meet the purchase price limits, and also meet the credit score DTI requirements and all the other requirements that are listed on the MCC program description. Although it's not an official program requirement, in order to benefit from the MCC, your borrower must have sufficient tax liability. And this is really important because we would hate for a borrower to be sold a product that they can't actually benefit from. And the refresher training, we will talk about how to evaluate a borrower for the MCC program. As far as calculating the credit, we have a credit rate of 25%. And so to calculate that credit, you would multiply the interest paid during the previous year by 25%. In this example, that comes out to $2,064. By IRS requirements cap that credit amount at $2,000, and so anything above the $2,000, including in this example, will be capped at $2,000. So how this is applied is, let's say that your borrower has a federal income tax liability of $3,000 before the credit is applied. They have a credit worth $2,000, so at tax time they apply that, and the taxes owed are only $1,000 in this example. If there had been some unused credit, let's say that their federal income tax liability was only $1,000 and they had this $2,000 credit, then that extra $1,000 could carry forward for up to 3 years. Borrowers with lower loan amounts and interest rates aren't necessarily going to realize the full $2,000 maximum credit for this program. So, a lot of borrowers come in thinking they're automatically going to get, if they use the MCC, they're automatically going to get $2,000 off their federal income taxes. But it's important to explain to them that it's based off of, it's a percentage of the mortgage interest paid the previous year. So I have an example here of $150,000 loan amount at a 3.625% interest rate, and that MCC is going to be worth less than $2,000. And then on top of that, they also need to have the tax liability to benefit from this. So even if they have a MCC worth $2,000, if they only have a tax liability of, say, $500, that is all that they can get back on their taxes. I like to explain that it's like a gift card. So if you have a $2,000 gift card to a store and you go in and you buy something worth $500, you're going to get that item for free. But the store is not going to give you $1,500 in cash in addition to the item. So it works the same way here. You have the tax liability, which is similar to having a product in a store that you want to buy, and then the gift card is similar to the MCC credit. When we talk about federal income tax liability, we are referring to your tax obligation. So this is the total amount that you owe the IRS regardless of when you pay it. So some people have lots withheld from each paycheck, and then when tax time comes along, they don't owe anything or they get a refund. And then there are others who have less withheld, and when tax time comes around, they might owe the federal government something because they didn't have enough withheld throughout the year. The tax liability is the same in either scenario. It's just whether somebody owes or not or gets a refund is just going to be dependent upon how much was withheld, not based on their tax liability. And so just to emphasize again, refund tells us nothing. When I talk to borrowers, I hear often, oh, well, I got a refund last year, so this program's not a good fit for me. And again, refund is just irrelevant in this conversation. What you really need to do when you're talking to borrowers is look at their tax returns and determine whether they have a tax liability. And that is actually surprisingly easy. And we will go over that right now. So in this example, we have Ben, who's a teacher, so he has a modest income. He's a divorced, single parent, has 2 kids that he claims as dependents. So he's looking to buy his first home. And so you, as the loan officer, need to determine whether Ben would be a good fit for the MCC program. So the first step you're going to do is you're going to find his current federal income tax liability. And this is easy because he's a first-time home buyer. He's interested in the Minnesota Housing Program. He's got to supply you with 3 years of tax returns. So you take a look at those tax returns and you want to look at the specific line depending upon which tax form that he had used. And so with that, you go and he has a 1040A, and so you're going to look at line 39 where it says this is your total tax. And you can see that he only has a tax liability of $39. So this is going to be of little benefit to Ben, this program. Again, just like I talked about with needing a tax liability in order to benefit from it, he has a credit worth as much as $2,000, but when he only has a $39 federal income tax liability, that's the most that he's going to be able to use of that credit. And on top of that, once he buys a home, he's going to also be taking the mortgage interest deduction for the remaining 75%. And that mortgage interest deduction is going to wipe out what little tax liability that he has. But let's look at a different example. We have Ben's coworker, Jose, a fellow teacher, similar modest income, but the difference is that he is single with no kids. So his tax situation is going to look very different. And in his case, he actually has a very substantial tax liability at $4,400. And if he has, let's say he has a mortgage credit certificate worth the maximum $2,000, he will be able to cut his tax bill almost in half. So he would be a great MCC candidate. Other things that you want to keep in mind when evaluating whether somebody would be a good fit is maybe you have somebody who doesn't have a lot of tax liability right now, but let's say they're a student and a year or two when they graduate and get their first job out of school, they're expecting to have a tax liability, then this program they might still think it's worth it, even though it's going to be a year or two before they start benefiting from having that tax liability and then being able to reduce it with the mortgage credit certificate. Just like with our startup program, our MCC program has its own disclosure summary, no signature required on this, but we highly recommend that you give this to your borrowers because it explains in plain English what forms that they're going to need to sign at closing and why. As far as those forms that they will need to sign, here is a list of them. The first 3 look almost identical to startup forms because the startup program has its own forms with the same names, but it's really important that you make sure that the borrowers are signing the correct document set. These MCC forms, while they look almost identical, there is some MCC specific language embedded in those, which is why we have two different document sets. It is easy, though, to make sure that you're using the correct documents. You just look at the top of the page. If it says MCC or mortgage credit certificate, you got the right one. If it says startup, you got the wrong ones. The two at the bottom here, those are specific to the MCC program, so there's not going to be any startup counterpoint to mix up with those forms. And finally, as far as forms go, no mortgage deed amendments are needed with this program. It's something that we do see some errors with, and so we don't want you to execute that by mistake. Doing the MCC program is just as simple as doing the startup program. So I'm just going to review a bit of the process. You have borrower comes into your office, meets with you, or applies online. That borrower is going to need to qualify for an underlying mortgage product. So FHA, one of our exclusive conventional products, RD or VA, and then you're going to qualify them for the MCC program, verify that they're a first-time home buyer, that they meet our income limits, and so on. You're going to reserve that, lock that loan in the system, just like you do for startup. And then at closing, you're going to execute the MCC documents. And then when you fund approve that loan, after closing, we know that it is closed, and then we will issue that certificate directly to the borrower. It will be the borrower's responsibility to claim that credit annually on their federal income taxes. The only extra step for lenders with the MCC program is filing an annual report with the IRS. However, this is very simple. We fill out the forms, we mail them to you. All you have to do is fill out your company's information, sign it, and mail it to the IRS. You only have to do it once per borrower. So for any borrowers that have loans closed in 2017 with an MCC, come January, you will get this IRS report from us. And now that the program is ending in 2019, you will not have to. There will be no more filing once this program is finished. When you lock those loans, you have 45 days from the date of commitment to when it is delivered to U.S. Bank, or when those image files are received by U.S. Bank. If you have want to know more about our rate lock policy, you can look at we have a link here to our rate lock guide. When you lock these loans in our system, you're going to be locking this as the mortgage credit certificate program. So you see below you have the startup, step up. This one is going to be locked as the mortgage credit certificate program. And then you just want to double check that you have the correct product in the allotment and allocation. And if there's a monthly payment loan, you want to make sure that that is selected as well. As I mentioned before, once you fund approve that loan, and that's why it's so important that you fund approve this loan as soon as possible after closing. And of course, before you fund approve that loan, make sure that all the information in our commitment system does match what's in the file. So if a loan amount has changed or borrower's calculated income has changed, just make sure everything in the system matches the file. Fund approve. We know that that loan has closed. We will issue the certificate to the borrower. It does not look fancy. It's just a Word document with a lot of legal ease, but it is important that the borrower hold on to that document because they will need that at tax time. When we mail that certificate to them, we do include instructions on what they will need to do. So we will tell them that they're going to need to fill out IRS Form 8396 and enclose a photocopy of the MCC, or if they're using a program like TurboTax or something, that will walk them through and automatically generate that form for them. and then they only need to submit a copy of the MCC if they get audited. As we come up to the end of this refresher training, I wanted to point out a couple different resources for the program. All of this is located on our MCC page. So we have the procedural manual and we have the program description. This program description is, you see a screenshot here. This just lists in chart form all the eligibility requirements of the program. We have an MCC lender guide, and that contains some talking points about how to talk about the benefits of this program to your clients. It also includes that chart to tell you which line you look at on a tax return to find that tax liability. Another great resource is the MCC Potential Savings Calculator. You or your clients can just go onto our website, pull this up. You can type in loan amounts and interest rates, and you can see how much, if the borrower says, hey, we found this house and we want to see, do we max out at the $2,000 for this property with the MCC program? You can type that information in and show them how much of a tax credit they could get. So I'm going to do a quick website tour just to show you where some of these resources are. And I know things can sometimes get buried a little bit on our website, but you want to be in our homeownership lenders section. And we have all of our program pages at the top here. So if you go to MCC, when you scroll down, this is where the procedural manual is, the eligibility income worksheet, program description. This lender guide is the one that I mentioned to you as where you would find the chart to show you which line of a tax return you need to look at. All of our forms are right here. So all the ones that I listed on one of the previous slides. And we have some additional forms depending upon the situation with the loan, like if personal property ends up being on the purchase agreement, you can have that signed by the borrower and seller. And then lastly, we have some of these resources that I talked about with you. We have the potential savings calculator here because this follows all the bond requirements. You might have use for a zero income statement or the non-occupant spouse statement. If you've done the startup program, all of these are going to be very familiar to you. And that concludes this program. Again, my name is Kirsten Partenheimer, and I am the MCC Program Manager. So if you have any additional questions or you have a question that wasn't addressed in this refresher training, please don't hesitate to contact me. I'd also be happy to talk through with you specific scenarios. So if you have a client you think this program might be a good fit for, but you want to talk it through with somebody, again, just please give me a call or shoot me an email, and we can talk about that. Otherwise, please remember the MCC program when you are meeting with first-time homebuyers. It's a really quick evaluation, just looking at their tax returns to see if they could benefit from this program. And if they do, then you can have that conversation with them. And then from there, just keep in mind our deadlines that if you are going to use the MCC program, the loans have to be locked by December 18th, and they have to close by December 31st.